Warren Buffett, often referred to as the Oracle of Omaha, is one of the most successful investors in history. For decades, his investment strategies have turned modest sums into billions, and his wealth continues to grow. But what's the secret to his remarkable success? What can we, as everyday investors, learn from this investing legend to apply in our own stock market journeys? This story is about the crucial lesson I learned from Warren Buffett that completely changed the way I approach investing, and how this simple yet powerful insight can help anyone achieve long-term financial success. 1. The power of long-term thinking. When I first started investing in the stock market, like most beginners, I was focused on making quick gains. I wanted to buy low and sell high, jump in and out of positions, and follow the latest hot tips or trends. It was exciting, yes, but also exhausting and, more often than not, unprofitable. Then I came across a quote from Warren Buffett that completely reshaped my perspective on investing. Our favorite holding period is forever. These words struck a chord with me. Buffett wasn't in it for the short-term wins. He was focused on long-term growth. He didn't care about short-term market fluctuations. Instead, he sought out businesses with solid fundamentals, great management, and a long-term competitive edge, companies that would continue to thrive over decades. This long-term mindset was something I had never considered before. In the world of investing, patience often isn't just a virtue, it's a key to success. I realized that by thinking long-term, I could stop obsessing over daily market movements and instead focus on the companies I truly believed in. I didn't have to make quick decisions. I could give my investments time to grow. 2. Invest in what you understand. Warren Buffett's second principle is deceptively simple, yet incredibly effective. Never invest in a business you cannot understand. He is a strong proponent of investing in companies whose products or services are familiar to him. At first, I thought this sounded too simple. Shouldn't I be looking for hidden gems and complex strategies? But after reflecting on this, I realized the brilliance behind it. If I couldn't understand how a company made its money, its risks, or the value it provided to customers, then how could I confidently decide whether it was a good investment? Buffett made his fortune in companies like Coca-Cola, American Express, and Geico because he understood their business models. These were simple, easy-to-understand companies that had predictable and stable earnings. He wasn't trying to outsmart the market. He simply invested in companies with products people loved and that had a clear competitive advantage. This advice changed how I approached my investment strategy. I started focusing on companies I genuinely understood. Instead of trying to follow the latest tech stocks or niche industries, I went back to basics, investing in businesses with straightforward models, strong brands, and loyal customer bases. By focusing on what I knew and understood, I felt more confident and comfortable with my investments. 3. The importance of value over price. One of the most impactful lessons I learned from Warren Buffett was the distinction between price and value. Buffett has often said, "Price is what you pay, value is what you get." When I first started investing, I focused too much on the price of stocks, how low I could buy them and whether I was getting a good deal. But Buffett teaches that the true value of a stock lies in its intrinsic worth, not just its price tag. In other words, I had to focus on what a company was really worth, not just what the stock was trading for. A company might be trading at a low price, but if it was struggling financially or lacked future growth potential, it wasn't truly valuable. Conversely, a company with a higher price could be undervalued if it had strong fundamentals, competitive advantages, and a promising future. This concept is crucial for making smarter investment choices. For example, when you hear about a stock that's cheap, it may seem tempting to buy, but it's important to ask, why is it cheap? Is the company struggling or facing headwinds? Or is it undervalued by the market due to temporary circumstances? Buffett has taught us that patience, research, and an understanding of intrinsic value are key. I began to look beyond the stock price and started evaluating companies based on their financial health, market position, and long-term potential. This shift in mindset has allowed me to make better investment decisions and, ultimately, experience greater success in the stock market. 4. The importance of moats. Another vital lesson from Warren Buffett's investment philosophy is the concept of an economic moat. Buffett often refers to companies with strong, sustainable competitive advantages as having a moat around them, protecting them from competition and market forces. In a way, a moat is like the protective barrier that keeps competitors away, ensuring the company can continue to grow and thrive. Companies with strong moats tend to have reliable cash flows, dominate their market segments, and maintain a position of power over their competitors. Brands like Coca-Cola, Apple, and Costco are prime examples of businesses with powerful moats. This was a game changer for me. I started to look at companies not just in terms of their earnings and growth potential, but also in terms of how well protected they were from competition. Did they have a loyal customer base? Were their products or services unique and irreplaceable? Did they have economies of scale or strong brand recognition? When I began focusing on companies with wide moats, my portfolio became more resilient. I found that companies with these types of competitive advantages were not only safer investments but also the ones that delivered strong returns over time. By seeking out companies with solid, defensible positions in the market, I could invest with confidence, knowing they would continue to thrive in the long run. 5. Patience and discipline, the virtues of long-term investors. Warren Buffett has always emphasized the importance of patience and discipline in investing. He often says, "The stock market is a device for transferring money from the impatient to the patient." This sentiment resonated with me because, in the past, I had been guilty of making hasty decisions, selling stocks during a dip or trying to time the market. But Buffett's wisdom taught me that long-term investing isn't about quick wins or trying to predict the next market trend. It's about being patient and disciplined, sticking to your investment strategy, and waiting for your investments to grow over time. This patience paid off in my own journey. By not reacting to every market fluctuation and focusing on my long-term goals, I was able to ride out downturns and capitalize on the steady growth of my investments. I realized that while the stock market can be volatile in the short run, over the long term, it tends to reward those who are patient and stick to their plan. Buffett's consistency in this approach is key. He's not swayed by market emotions, and that's why he's been so successful. This ability to tune out the noise and focus on the fundamentals is a quality every investor should strive for. 6. The role of emotional control in investing. Another key insight I learned from Warren Buffett is the importance of emotional control. One of Buffett's most famous sayings is, "Be fearful when others are greedy and greedy when others are fearful." This is perhaps one of the most profound pieces of advice I could take from him. The stock market is driven by emotions, fear, greed, optimism, and panic, and these emotions can often cause investors to make poor decisions. I found that during market downturns, it was easy to get caught up in the fear and sell off stocks. Conversely, during periods of market euphoria, it was tempting to buy into the hype and overpay for stocks. But Buffett teaches us to act rationally, not emotionally. When others are fearful and stock prices are low, that's often the best time to buy. When the market is in a frenzy and stock prices are inflated, that's the time to be cautious. This mindset helped me navigate the ups and downs of the market with greater ease. Instead of succumbing to panic during downturns, I learned to view market corrections as opportunities to buy quality stocks at a discount. And when the market was soaring, I learned to take a step back and evaluate whether my investments were truly worth their prices. 7. Focus on quality, not quantity. Warren Buffett is known for making fewer, more calculated investments rather than spreading himself thin across dozens of stocks. This is another crucial lesson. Focus on quality, not quantity. Instead of trying to build a massive portfolio with dozens of stocks, Buffett concentrates on a few high-quality companies with a strong future outlook. This strategy resonated with me deeply. I realized that owning fewer, more carefully selected stocks was a far better approach than owning dozens of random companies in the hopes that some would perform well. By focusing on a smaller number of businesses, I could do deeper research, understand the companies better, and invest in the ones I truly believed in. Quality over quantity not only leads to better returns but also allows you to spend less time managing your portfolio and more time enjoying the process of investing. I found that by following Buffett's example and concentrating on a select group of businesses, I was able to see more consistent and sustainable growth in my portfolio. 8. Learn from mistakes but keep evolving. One final lesson from Warren Buffett is the importance of learning from your mistakes but always evolving. Buffett is known for his self-awareness, and he often admits when he's made a mistake. He says, "The best thing I did was to choose the right partners, and the worst thing I did was not to pick more." Investing is a journey of trial and error. Along the way I made plenty of mistakes, some I'm still learning from. But instead of getting discouraged, I chose to view these mistakes as valuable lessons that shaped me into a better investor. By focusing on constant improvement and learning from my errors, I was able to adapt and refine my investment strategy over time. Buffett's ability to evolve and grow from his mistakes has been a huge inspiration for me, and it has given me the confidence to keep moving forward no matter what. Conclusion. The stock market secrets I learned from Warren Buffett completely transformed my approach to investing. From focusing on long-term growth to investing in businesses I understood, Buffett's wisdom has guided me towards smarter, more thoughtful decisions. By embracing patience, discipline, and a focus on quality, I've seen my investments thrive in ways I never thought possible. The true power of Buffett's investing philosophy lies not in flashy strategies or complex models, but in simplicity and consistency. By staying true to these principles, anyone can succeed in the stock market. It's not about making quick money, it's about building wealth over time, and in the process, learning, adapting, and growing. If you embrace these lessons, you too can become a successful investor just like Warren Buffett.